So is it better to dollar cost average or buy one time, try to time the market, or make a lump sum investment? So I'm going to use the example of, I'm going to use triple Qs as an example here. I'm going to download all the data. So historical, I go to Yahoo Finance, click on historical data, select max time period, apply, and then I could just download. So I already did that and put it in a spreadsheet, and I calculated the average annual return if it was a lump sum investment, and then I calculated the average annual return if it was if you dollar cost average. Now in this example, I did $100 every day, or every day the market was open, $100. So if, for example, if we had started since inception on the triple Qs, so since 1999, and put $100 every day, the number of days that was possible is about 6,191. So that means the equivalent lump sum investment would have been 619,000. So if you had done that, so since 1999, and now we're 2023, so it's about 24 years, you could see that the average annual return for the lump sum was higher than the dollar cost average. So the lump sum, it was 25%, while the dollar cost average return, the annual average, was 20%. Now, of course, triple Qs was at 51. In order for the average annual return on the lump sum to be better than the average annual return while dollar cost averaging, you need to time the market perfectly. So because this was considered a low price, and that's why at this stage you could see that the lump sum return is higher than the dollar cost average. But as you scroll down, you could see that there are some points where it's actually better to dollar cost average. So you can see at this point in October of 1999, dollar cost averaging, if you had started dollar cost averaging instead of if you had invested a lump sum, dollar cost averaging would have been slightly better. And if we continue lower, you could see here at the end of 1999, dollar cost averaging would have been better, 20%. You can see that dollar cost averaging is a bit more consistent. It's always 20% average annual return on the triple Qs, while a lump sum investment fluctuates a lot. If you time it perfectly, then you get the better return. At this point here, end of 1999, we're at 14%. Scroll down, even in 2000, if you had started investing in 2000 and you had just put in lump sum, or instead invested that same lump sum every day equally, you'd be up 21% if it was dollar cost average. You'd be up 11% average annual return if it was a lump sum investment. Scroll down again, you could see dollar cost average is better in the year 2000. Now remember, from 2000 to 2003 was pretty flat, right? The triple Qs was pretty flat. In fact, it dropped in 2000. Here, let's look at the chart. So let's look at the chart of the Qs, triple Qs. So where are we here? We are at, 2000. Let's go to 2000. So yeah, you could see 2000, from 2000 to 2008, or even more. It took a while. It took more than 10 years for the triple Qs to recover from 2000, and yeah, or maybe even a little bit more. So this period here would have been terrible if your lump sum was done before 2000. But if you had dollar cost averaged, so you bought at these low points, then yes, you would be better off. But for a very long time, you would not be making a return. So let's go even lower. Let's go to 2001. So now it's creeping back up again, because you at this stage, at this point, you're buying at a low. You can see the beginning of 2000, it was trading at 90, but end of 2000 or beginning of 2001, it's down to 50 and 60s and even 40s in 2001. So if you had done a lump sum investment here in 2001, your average annual return would have been higher than dollar cost averaging because you actually had good timing. But because you cannot control timing, it's simpler to just dollar cost average. And this is what this spreadsheet here proves. If you can time it perfectly, then it's better to do a lump sum payment investment. But if you can't, and if you know you can't, then just dollar cost average will give you it's pretty consistent since the beginning. It's always around 20%. So let's go even further. You could see here 2004, your average annual return, if you had done you would have bought it at 37. So for sure your average annual return would have been much higher, 46% compared to 21% dollar cost average. 2004 or even I guess the best time to do a lump sum investment would have been 2002 in September. So let's go back to the spreadsheet just to confirm this. 2002 in September, we're almost there. So September, yeah, as you could see, 80% average annual return. Yeah. So that's called timing it perfectly. We've got prices of $19 here. But yeah, while you're making 82% here, if you had put everything in one shot in 2002, it would have made 82% average annual return, but dollar cost average is still 22%. So let's go see 2008, another important date. So yeah, 2007, 2008, you can see it's in the 40s, 30s, while dollar cost averaging is still 20% return, average annual return. So these are average annual returns. So 2008, we get the 80% return again, I guess because we've got much lower prices. 2009 as well, 90% average annual returns, while we're still at 19%, 20% for the dollar cost averaging. So you can obviously see the conclusion is pretty obvious. You want something safe and consistent, go with dollar cost averaging. If you're good at timing the market, then time it and put everything in one shot. So just be self-aware and know yourself. 2010, the dollar cost averaging return is dropping to 16%, I guess because we're buying at a higher price now. The lump sum is at 45, and if we continue even lower, 2011, dollar cost averaging return is dropping to 14%. 2012, we're dropping to 13, 12. 2015, we're dropping to 12%, 11% for the dollar cost averaging. So this basically means if you had started investing in, 2017, and you had dollar cost average since 2017 all the way to today, 2023, your average annual return on the triple Qs would have been 9% if you had started in 2017. While if you had put all your money in one shot, your average annual return is 25%, which makes sense. You've got the triple Qs is at 141. Right now we're at 370. So let's do a quick spot check here. So we're at 370 divided by 141. So minus 1 times 100 divided by how many years? So 2023 minus 2017 is 6 years. So that gives you about 27% average annual return, which makes sense. And now for the dollar cost average annual return, well, you have to see if you put $100 every day from 2017 till 2023, how many shares you end up having at the end. Well, that's what this is for. So if I just sum it up till the end here, so I would have about, let's say, 700 shares. So I'd have about 700 shares at 370, but I would put $100 every day. So 700 shares times 370. So I would have 259,000. But there's the count of 1602. But I put $100 times 1602. So I put 160,000. So that divided by 160,000, 20 or 200, I get 61. Only a 61% return in 6 years. So minus 1 times 100 divided by 6 years gives me about 10%, which makes sense. So where we were 2017, let's go to 2018. You can see that it's dropping to 5%. So you can see the growth, most of the growth happened between 2000 and 2010. But at this point now, it's not growing as fast. And now the average return, dollar cost average return is 4%, while the lump sum is only 8%. That's because in 2020, triple Qs is at 295, and in 2023, we're at 370. So that makes sense as well. So the conclusion I can get from this is, over a very long period, dollar cost averaging is better and safer because it's more consistent, and you still get a decent return on the triple Qs. You'll get a 20% average return over a long period though. Over short periods, so I guess under 10 years, so if we start looking at 2013, because that would be 10 years, well, you still get 12%, which is not bad. But as you can see, like 5 years or 6 years, it starts to drop. 3 years, of course, is going to be very low. And the other conclusion is, if you time it perfectly, you would get a much better return. And let's look at, obviously, we're starting to get negative returns here, because in 2021, triple Qs is at 400. Right now we're at 370. So we're actually down if you had done a lump sum investment. But if you dollar cost average, I don't think you're ever down. Well, yeah, here's too close. Here's just a few days, so these don't really count. But you would never get a negative return if you dollar cost average, or you rarely do. Yeah, I don't see any negative returns if you dollar cost average, but you could potentially get negative returns with a lump sum investment.